That's for me.
Location fits into it. So the long and the short of it is.
Absolutely. How about at the end of the day, do you do anything? Like, I'm really fascinated by rituals and things like that.
So I think it's really important to be ethical and make sure you're paying them well above.
Renovators is that, you know, when you look at a property, especially if it's a future home.
Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Hello and welcome. If you can hear me, please let me know. It's my pleasure to have you with me. I can see Sona's already published something in the comments, as has Lee. If you can hear me, let me know, because we're setting up in a new office here. So I just want to make sure that we're all systems go. And I've got a bit of a kind of like a bit of a cockpit here in front of me. And I just have things flying at me in every direction. So say good day in the chat if you can hear me. We're here for the Investor Mailbag, our first segment, first of its kind in this office. So it's two firsts, but let me know. And I've also got a new computer here. I've been a bit outraged by old Apple doing us a favor and reducing what they give us, but increasing the price. Sounds like a good investment. So thanks, Steve. You can hear us, Stuart, Samantha, everyone. Fantastic. So today we've got the mailbag segment, which is fun because we just get to answer questions. And that means that you should just chuck all the questions into the chat, whether you're on LinkedIn, Facebook, X/Twitter, or YouTube. You can chuck that in. I've got a bunch of questions that have already come through, some sent in advance, which I'll get to in just a moment. But I think I've got my screen ready to share now, so I should be good to do that. Thank you, Percy. Thank you, Belinda. Okay, so if you're new to the Rask Live show, what is it? So every week we call it Rask Invest Live. We go live on Thursdays at 12 at midday. That's Eastern time, Melbourne, Sydney, Brisbane, if you're on this clock. And we go live, we talk about all different types of stuff. On the first, this is a question I got sent this week. Hey, Owen, when do we talk about the fake news portfolio that we run every month? So the fake news portfolio is indeed fake, and it's what we're building together over the first year of Rask Invest Live, and then we'll transition to tracking that over time with our partners from Navexa. And you can visit this. You can visit us online at the raskmedia.com.au/live website, or landing page, I should say, and you can see like recent show notes, information you might need. But you can also track the portfolio in real time, so you can see it here. You can see how many Wesfarmers units we bought, how many we've still got in the AAA cash ETF from Beta Shares, and so on and so forth. So you can see all of that on the site. One of the things, so that's the first Thursday of every month we do that. So you can submit all of your comments and what have you over in the Rask community. You can put companies up for contention. So the way you do that is you just jump into the Rask community, which is just community.rask.com.au. And in there, you can find the events page, which is just here on the left-hand side. You can click on this and you'll find all of the shows and things that we've got coming on. It's not just Rask Invest Live. At the moment, it's looking like that. But normally we put in like actual physical events where our team will be, as well as other shows that we might be doing live, like live streams, webinars, and stuff like that. It's all free, obviously, so you can get all that here inside the community. And that's the best place to contribute ideas for upcoming shows, and in particular, that fake news portfolio. If you haven't already subscribed, if you're watching on LinkedIn or Facebook or X/Twitter, jump on over to Rask's YouTube channel, because that's where you'll get the best experience. It's where most people watch. And of course, you did hear a general advice warning in the preamble, the intro to the show. But just in case you've forgotten or you're just tuning in a little bit late, anything that I do say in these shows is strictly general in nature, because I don't know your needs, goals, or objectives. So when you do send a question in, I've got a thing on this in just a moment. Keep it general, because it actually makes it easier for me and any of our podcast hosts, or even the financial advisors can't give you personal advice on a podcast. So make sure that you generalize your question and have a bit of fun with it. Like, we're all here to laugh and smile. Although this show is called Rask Invest Live, we also do have an investment platform called Rask Invest. So for the avoidance of any doubt, I'll just bring this up here. For the avoidance of any doubt, if I do use the term Rask Invest and say, hey, you could invest with us at Rask Invest, that is a financial product, and it has a product disclosure statement, which you can view on the Rask Invest website. It also has something called a TMD, or target market determination. The key difference is the PDS kind of tells you everything about the thing that you're about to invest in, or like insurance. The TMD is so you understand which of the options and if it's suitable for you. Even though we can't provide personal advice necessarily, we may be able to tell you in that document whether or not it's suitable, and you can find all that online. So I'm really grateful to our partners, just quickly, Pocketsmith, Navexa, Superguide, Perla, Rask Invest. Thank you for your support, and everyone I know use many of these things. James, you've just come out swinging with a good question. Can you explain AMIT cost-based adjustments? Do you need to factor these in when doing a tax return? Yes, you do. So 1 second, I will get this up. There was Navar, who is the founder of Navexa. He did in the community share a recent post about this, mate. So I can bring this up, and he even did a video for you. James, there you go. It's coming through to you right now. And you can see here the adjustments. He also walks you through in this video how to actually do it and calculate it. So that's available for you there, my friend, and it's all yours. So the question which I want to prioritize at the top of the show, actually, before I get to that, I just want to quickly go over this. So when you do send in a question, there's 3 ways to get your question sent in. You can do it live here on the show, which I'd probably encourage you to do, like here now. You can do it in the community. You can head to the events section, as I showed you before, down the left-hand side, find the upcoming event, the mailbag or whatever. And the third way is when you head to any of the Rask websites, you'll see this link in the menu up the top here. It says ask a question. You can just click on that and it will take you to a page, and there'll be a form there where you can fill in your question. You can give us a funny name. And then basically what happens is this little widget, which you'll see load in just a sec, this will actually prompt you to say, where do you want this question answered? And what you should say is the Rask Invest live show. My internet's a bit slow today, but it will tell you Rask Invest live. It will pop up and so on and so forth. Select that. And what do I see on the other end? Well, I see thousands and thousands and thousands and thousands of questions. So this is what I mean about trying to keep it funny, trying to keep it, nice and lighthearted and easy for me to answer, because there are so many questions that we get, and it's absolutely amazing. But please just try and think of that when you ask a question. I'm just going to try and answer as many as I can to make them easy for me. So this is finally the important warning. Try not to give me any of your personal situation, because I won't be able to answer if it gets too in the weeds because of the laws here in Australia. So for example, if you were to ask a question like, what is debt recycling and how can someone do it if they have an existing mortgage? That's a really easy question for me to answer. What's not always easy for me to answer is something like, I have $100,000 in equity and I plan to invest it in the IVV ETF. Can you tell me if that's a good idea? Because I have personal information about you, it makes it more tricky. So then I have to generalize it. And this is not just me, it's anyone that's licensed in Australia. Anyone that would go ahead and tell you what to do or recommend something to you is acting illegally in Australia. So I hope that makes sense. Okay, so the question probably the question that I really liked this week came through in advance, and it did come via our community. It's about debt recycling, but it goes a significant way further than just talking about debt recycling 101. But for those of you that don't know, what I'll do is I'll zoom out a bit and I'll explain what is debt recycling or just equity release. They're kind of two different things, but they're basically the same process. So basically, what is debt recycling? So debt recycling is this idea that if you have some amount of money, so let's say we've got this. So say, for example, we've got a property and the property is worth, we'll just use round figures. Say the property is worth $1 million. Now, say, for example, exactly half of that is in a loan. So this is the loan and this is the equity, right? So this is the bit that's got the interest applied to it. So this is $500,000 and you get the drift, right? I'm just going to write 500 right there. We'll go a bit of a K. So 500K is the loan. Basically, what we're saying is if you have this in your situation, say, most banks will allow you to lend up to 80%, right? So they will allow you to redraw, even if you've paid down the mortgage and you've been a good saver and all of that, you can redraw up to 80%, right? So if you then took, let's say we've got a different color. Let's say if you then took this line and continued across, this is where the original 50% is. And if we go back, this is where the new 80% is. That means that this area in between here is what we can redraw. The bank will allow us to refinance through a mortgage broker or through them directly and say, can you put that in cash in my bank account? So this is exactly what I did 2 weeks ago. So if we take this, and so the question has just come through here from Tim and Percy, can someone sell their portfolio, which they paid for with their own money, put the proceeds on their home loan, split it, redraw it, and then rebuy everything they just sold? Yeah, I mean, there's probably a lot of, the short answer is probably, but the best answer would be, Tim, to actually speak to your accountant on this one. The reason, not just for general gist, but there are a few things that come into this, Tim. So there's a thing in Australia called the Div 4A. So Div 4A is a rule in Australia that prevents people from making a decision for a tax benefit. So it's solely for a tax benefit. It's basically tax avoidance. So what they try and say is you can't make a decision solely based on that. And so if anyone was to ask, you have to be careful about that. So that's where an accountant can help you out. But secondly, is there may be significant costs and capital gains tax to pay on the way through. So if someone was paying capital gains tax on a portfolio of shares that they've owned for years, they're going to lose a lot of that money just to then get the interest tax deductible, if that makes sense. So let me just keep going and I'll hopefully get to Percy's point here. So if we continue on, right? So in this situation that I've got here on the screen, if someone was in this situation, they're like, okay, well, if I've already got the 500K over here, that means I could go up to 800K, which would mean that that's approximately $300,000 that I could withdraw from the new loan that I get, because remember the loan's now at 80%. I could take this portion, right, cash it in, go to the casino if I wanted to, although I think that'd be a horrible idea. It'd be just absolutely horrible. Take that 300K and then invest it. And you'd probably be like, well, why would you invest that money and not just, just keep adding cash? Like a lot of people, the old school kind of traditional way of doing things was that, pay down your mortgage, get debt free and do all that. The idea of debt recycling is that according to the law in Australia, there is potential to take some amount of money that you've loaned and then invest it. But because the amount of money that you're investing has interest attached to it, effectively, you're paying interest to invest, and then you're paying tax on the returns that you get from that investment. So you're paying tax twice. So in effect, what's happened is they say you can claim a tax deduction for your interest if it is used for income generating purposes. So this is the idea, is when you take that $300,000, when it's in your home loan, you can't claim a tax deduction for paying your mortgage, but you may be able to claim a tax deduction for an investment property. So that $300K gets put towards an investment property, or maybe it gets put towards a portfolio of shares that pay dividends. So I am not a tax agent. So I took this question and I asked someone who is a tax agent. The question is, I have a mortgage in a redraw account for our principal place of residence, otherwise known as our home. They go on to say some things, and they say, I want to redraw the money and invest it into an ETF so that the interest can be tax deductible. Okay, so this is basically just a typical redraw / recycling situation that someone is doing. I have no idea who this person is. This, for the purposes of today, is a hypothetical situation. They say they've heard about something called mixed loans, and they wonder if that's a bad thing. So I went and asked tax agent Jordan Kiddis, who co-hosts our Australian business podcasts. I said to him, tell us about this. And he said that Section 8.1 of the Income Tax Assessment Act is the one that people should be Googling. So in this part of the law, he summarizes and says the ATO requires that the purpose for which the borrowed money or any capital is applied must be genuinely for income producing purposes, right? For the interest or expenses to be deductible. So it must be genuinely used for income producing things. This is important because according to my research, if someone invested in something that doesn't produce income, then not only will it not produce any income, it may not be tax deductible at all. So that's something to really keep in mind. He goes on to say it emphasizes the substance over the form of principle, meaning that regardless of where the funds originate, the essential element is that the funds must be used to generate assessable income. So regardless of where the funds come from, he's saying the essential element, this is like the secret ingredient. Like if you're cooking a lamb roast, you need lamb. If you're debt recycling, this is the thing that you need. It must be generating income, right? So that's the key one there. Now, then I asked him about the mixed loans idea. Like, what about this thing called mixed loans? Is that actually a thing? And he says, it's true that redrawing money from a home loan, especially one that was previously used for private purposes. So what he means here is like where you live rather than for an investment, can create something called a mixed loan. A mixed loan is one where borrowed funds have been used for private, i.e. non-tax deductible, and investment, potentially tax deductible purposes. The issue with mixed loans is that it can be difficult to apportion the interest expense between the deductible and non-deductible components. So he's basically saying, if someone just mushes all the money around and it's sloshing around in a bank account, who knows? Who knows? Is that all tax deductible? How much of it? Like if, for example, if you took the $300K out, right, and then you bought a car, then you went to Fiji, then you, did a reno on your own house, and then you use some of it to invest, the question would be how much went here, how much went here, how much went here, how much went here, and then how much of the original loan that you got up to 800 grand was actually for each of those things. That's where it gets really tricky. That's basically what he's saying. So loan splitting is a strategy where you separate a loan into two or more sub-loans for different purposes. So effectively, you've just got like a different account for each. For example, you split your existing mortgage into one portion for personal use, the original loan, and another that's used exclusively for investments. By doing this, the interest on the investment portion of the loan can be more easily identified and claimed as a tax deduction, as it is clearly used for income-producing purposes. This avoids the complexities of mixed loans. So in effect, so far he's saying that, yeah, it looks like you can use money when you redraw under the law, and as long as you keep really, really good records and avoid some of the really common errors, you may be able to do it. So effectively, so in this case, he gives an example of you could split a mortgage so that $360,000 remains as a portion related to the home, and the $100,000 is then used for the ETF. The interest on the $100,000 investment loan can then be claimed as a deduction as long as it is used to generate assessable income. This is key here again, because some people go and invest in things that don't actually produce income. So for the thing that you're investing in, even if it's on the stock market, you got to ask yourself, is this producing income? Income. That's one of the key things. And this is why Jordan says you should, in this type of thing, always have a great mortgage broker, always have a great tax agent, always have a great financial planner. Now, I know a lot of people in the Rask community don't yet see a financial planner. You can, if we go to Rask Media, you can see, okay, so Percy, you've just asked, so my question would be, if I wanted to explore this, do I speak with an accountant or do I see a mortgage broker or both? Okay, so on the, that's a good question. So on the mortgage broker would be for lending. So if you needed to refinance, tax agent would be for the tax related component, and a financial planner would only need to come into the play for the strategy. So the strategy is like the investment strategy, because a tax agent, a typical tax agent cannot give investment advice. A typical tax agent cannot give credit advice. So this is where they all kind of play together. But most financial planners, however, in Australia now have something called a tax advisor role, meaning that they can give basic tax advice as well. So like around structuring, so debt recycling, family trusts, SMSF, that type of stuff. They don't do your tax return, but they can still tell you legally what you can and can't do. Now, in this instance, I would say for whoever this fictitious person is, that the tax agent is the one that they need to speak to first. The tax agent can say things. If you go armed with the right questions, this is what a lot of people don't know, and this might help you, Percy, is a lot of people don't know who to go to, but the secondary element is they don't know which questions to ask. And so for a tax agent, I'd be asking questions like, how much is my property worth? And if I could sell it and invest the money, how do I set it up so that the loan portion that I redraw is tax deductible? So I mentioned to you before that we recently did a refinance of our property. This is our own home. This is Casa del Rask. This is the Rask headquarters, if you will. So we recently did a refinance, and we did it through Flint, who many of you will know is our mortgage brokering firm at Rask. It's who we partner with. And so we did it through Flint, and we got a certain amount of money out. And what happens in that situation, just so you're aware, is I'll draw it first. So if you typically have your home, so if we go back up here, typically what happens is this extra $300,000, when you do a refinance, you'll still see the existing loan, but then you'll see the refinance amount, and that will come into a different bank account typically. So that basically means that when you're doing it, you see the money separate in your account. Like the day that you have your quote unquote settlement, when you refinance, the money will appear in a new bank account typically. And then you can see that that is the money that has been refinanced. So for example, if someone only wanted to pull out $100,000, or that was the amount of equity they could redraw, they would know that, and the only reason they were doing that was to then invest. They would know that that whole thing is going to be invested. So that component from that point on may be tax deductible. I'm saying maybe because I'm not the tax agent here, but that's how the typical process works. So you have the mortgage broker who is helping with the loan, helping structure that and set that up with the right bank. And then the tax agent's answering all the tax and more like the, is this possible? Is that possible type of thing. The financial planner typically only comes into the mix around actually what investments are made and how's the overall strategy coming together. With the financial planning, I should say that a lot of financial planners will recommend a strategy like this if the client that they're seeing, or the clients, if they're in a couple, is typically a bit more risk inclined, meaning that like they've got a higher risk profile. So instead of being really conservative, these people might be slightly more risky, so to speak. The second reason, like if you're in this kind of Venn diagram, the other reason that you would see a financial planner use this type of strategy is if the couple or the single is earlier in life. You don't see this in retirement, but you see it earlier in life because it's a long-term strategy. It requires an extra loan. So the downside, obviously, for most people who haven't picked this up yet, is that you're going from a $500,000 loan to an $800,000 loan. So you still got to pay the loan, which typically means you need a good income or salary to justify doing it so you can keep paying for the loan. And so keep that in mind as you go about it. Now, I did the same as everyone else. I did my mortgage refinance through Flint. I know a lot of our financial planning partners, these guys do it as bread and butter, by the way. It's like every day for them. The financial planners that I know that do a lot of this work with us, so many of you know that we also have financial planning partners, is when my page eventually loads, I don't know what's going with my internet, not those guys, is these guys right here. So, sorry, wrong one, Everest. So the team at Everest, I'll just pop this in the chat. So the team at Everest, they talk about this a lot. So we're having Alex here, who's one of the founders and directors of the business. He's going to come on the Australian Finance podcast in a couple of weeks, and he's going to talk about how to structure it properly, how to set it all up. And then obviously / and then Jordan, who is on our business podcast, he's the one that helped me out with answering this question. He's the one that I turn to for structuring and for like all this type of stuff. And you can typically, like the difference in these three things, here we go, is that a mortgage broker, this is like in order of, if you think about these three professionals, I'll change color. I don't really like that orange. Let's go with this random red color. So in order, this gets more expensive for you as a service as you go down. So at the top here, a mortgage broker is typically paid by the commissions that get paid for the loan. So you pay them, but it's paid through the bank. So that's basically for a cash flow, it's basically zero because you're not paying them, the bank's paying them. So you don't see it come out of your wallet, if that makes sense. For a tax agent to give you this advice, you would pay them for 1 hour consult and you'd say, this is my situation, this is what's happening. You'd probably be out of pocket about $250, say, per hour. You could probably just give them a phone call in 15 minutes and they could help you. But you'd say to them, you'd write it up for them. You say, this is how much is on my loan. This is what I think my house is worth. I would like to do this with the money. Does this make sense? And send it to them and get them in writing. So then it's like actual advice. But they'd probably charge you $250 for the consult or once-off advice. With a financial planner, they are under much more strict obligations. So they have to do way more in terms of helping you. So depending on your situation, this could be anything from like a very like small amount of advice, which is still not really that helpful for them. So you could be out of pocket from $1,500 at the very, very low end up to say $10,000. But typically just for like a 30 or 35-year-old, a single person, PAYG with really simple things, maybe you're out of pocket a couple grand, particularly if the insurance that you might get subsidizes some of their fees. So that's the difference. So the mortgage broker is going to help you with the loan. Tax agent's going to help you with the tax questions. And a lot of people do stop there. It's really only if they want really comprehensive advice, they keep pushing down below that line and get real advice. So I hope that makes sense. So Percy, but the interest of the 300K of the new 800K amount is the tax deductible amount. If I understand you correctly, so your monthly payments increase, so you have $309,000 to go invest in ETFs as an example. So in this instance, Percy, in this example, whoever this hypothetical person is would have an $800,000 loan, right? They would have, that's an 8. They would have an $800,000 loan that they owe Commonwealth Bank or NAB or whoever, right? Just like I have now a bigger loan than I did a few weeks ago. So my monthly repayments go up, but only a portion of that 800,000 is the actual money that I can claim a tax deduction for. So if it was $300,000, I could only claim $3 out of every $8 worth of interest, if that makes sense. I still have to pay the full amount of interest, by the way. That's the whole thing. That's the risk. Most people shouldn't do this strategy because they're still out of pocket every month. They still have to pay the full amount of interest. It's only the portion that they're actually investing that is tax deductible. Yeah. So I hope that makes sense. W, you write in and says, thanks, Owen. Just reconfirming. So no. So one can talk to a tax agent to split mortgage loans. The tax agent would answer the question of how do you do it? So if you called Jordan, so if you booked in a call to speak with Jordan, or that's what this page does. But if you called if you called your own tax agent or sent them an email and said, hey, my house is worth $479,000, bad example, in Australia, my house is worth $650,000. I've got a $300,000 loan. I've got some equity. If I was to speak to my mortgage broker, could I claim some of that as a tax deduction if I was investing in X, Y, and Z? And they would help you answer that question. And they would tell you you'd ask them, how do I do this so that your job is easy? Like, where do I put the money so that it makes sense from a tax perspective? Then they're not going to help you get the loan. They're just going to help you set it up so that you understand what you should and shouldn't do. So for example, if I come back to my hypothetical example, a lot of people in this situation, they get this $300,000 and it just sits in a bank account with their emergency fund. It sits in there with their holiday account. It sits in there with their other stuff, and they just mush it around with all the other stuff. And at the end of the year, the tax agent's looking at it going like, well, which bit's for what? Like, how am I supposed to know? And then the ATO says, hold on a second, Jeffrey, or whatever your name is, you've stuffed this up. We don't know. Therefore, we're going to assume that all of that money that you put out is not tax deductible because you've stuffed it up. So that's where the accountant will be like, hey, Jeffrey, you want to put this amount in this account. Do not touch that amount of money. That goes for investing. Then it's easier for us to track and blah, 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 blah. I hope that makes sense. In my situation, again, I went and spoke to Flint. They ordered the bank valuation. They spoke to the banks. They just said, hey, sign here to refinance. I was like, boom, done. Then I spoke to Jordan. I said, hey, if I invest this money, how do I make it so it's clean and easy to invest? He sat down with me for a little while, told me that this is the way I should do it, and this is what we need from a tax deduction perspective. Done, moving on. Now, if I was to go a step further, and I would call Alex at Everest and say, hey, Alex, I've just got this money. I'm thinking of investing it. Can you just tell me, should I invest in these shares? Should I invest in these ETFs? How does that affect my overall financial plan? That's where the financial planner comes in. So I hope those roles are more clearly defined right now. But these are the kind of, like, if you think about it, this is kind of like your A team. The other ones that you might go and see are a lawyer or something like that. But this is your A team right here. So definitely have a good mortgage broker. Like, I couldn't swear by that enough. Definitely have a good tax agent. Most people think they just want to file their own taxes and do ATO pre-fill and my tax and all that sort of stuff. Good on you if that's what you want to do. Go and save a couple of pennies. I'm not interested in that. As someone who wants to invest and wants to think about tax and wants to get good advice, and I value the human element, I just have an accountant that I pay. I might pay him a few $100 a year. It doesn't bother me. I think all investors should have a trusted accountant for many different reasons. So Phil, you mentioned a good point here, which is that you hope DHHF, which is the diversified fund from BetaShares. Full disclosure, BetaShares is a sponsor of our Australian finance podcast. So this ETF is the All Growth ETF. Now this ETF, you raise a really good point here, Phil, for the reason that some people go and buy things with the money that they get, and it's not actually tax deductible because it doesn't produce income. So you've got to understand what is going to produce income. And that's just, now with this one, you could go to their website and you could see what they've paid out historically. All your tax agent would probably do to make the assessment is they'd probably just go to the website and go, how much distributions or dividends did it pay last year? Is it likely to pay those this year? Does it meet the test? So on and so forth. So if you go to the BetaShares website, get out of the way. If you go down here, wait, where are the distributions? Distributions. Here we go. So here we can see recent distributions. So this one is paid dividends. It looks like it's paid dividends July, April, Jan. Yeah, so it's paid multiple distributions every few months, which is pretty typical. But I was speaking to, this is a good point, Phil, because I was speaking to another financial planner last week, because he was saying that this was just totally random, because we have our Rask Invest service, and he looked through, he had someone, he was designing an investment strategy for someone, and he was looking through all the individual ETFs that we own, because someone was like, hey, can I debt recycle and then invest with Rask? And he was like, well, the only way I could determine that is if all of the individual investments met the definition. Otherwise, he said, we would have to apportion it. Now, according to him, he suggests that they do. But let's say, for example, a good example of this is, let's say someone gets some money for a refinance or redraw or something. And then they say, oh, this is tax deductible money. And then they go and invest in gold, right? They go and invest in gold. That obviously does not produce any income. That would probably be a mistake. I'm not the tax agent, but that would be one of the very many mistakes that anyone could make. And so Alex, who will be coming on our Australian Finance podcast in a couple of weeks, he'll be able to answer these questions. So if you do want to send in Alex a question and it's a bit more like in the weeds, send a question in. Again, using that page, the Ask a Question link, just select the Australian Finance podcast. So I hope that makes sense. Now, I kind of do want to talk about something other than debt recycling, guys. So please, we do have some questions sent in advance, but please send your questions in now, because we will continue it on the podcast. Sona, you've said, I see that VDHG, which is a diversified ETF from Vanguard, has performed 9.46% compared to the Spider 200 funds, 11.58%. Hypothetically, she says, how do I decide if I should sell and just purchase that 200? What are the metrics I should be looking for? So I can answer the second bit. What metrics should someone be looking for? The first bit is a bit personal advice-y, so I'm going to kind of stray away from that and just answer it through the lens of what should someone look for. So the difference between VDHG, I'll bring up a new page for myself and I'll remove the lovely Jordan. I'll get rid of this. So we've got VDHG versus SPDR 200. I'll bring up that's actually STW. Interestingly, this was the first ETF in Australia, this STW ETF. So people don't know that. While there are plenty of variations, this was actually the first one. So if we go max here, this actually doesn't go the whole way back. But this has been going for a very, very long time. So all this ETF does is just invest in the ASX 200. So if we were to bring up the ASX 200 over the same time frame, we would see exactly the same chart, right? Or very, very close. Now, one of the things that's different about what we're talking about is we're comparing apples to oranges, or at least we're comparing Granny Smith apples, which in my opinion should only ever be used in curried sausages or some type of stew. We're comparing Granny Smith to something beautiful like this organic, I don't even know what it is here. But let's say, for example, with VDHG, we've got a pie chart. And let's say we know, because we do, 90% of VDHG is growth, right? So 90% is growth. We'll put a big G there like that. And 10% is defensive. So this is where the bonds and cash and stuff are, right? With the Spider 200, aka STW, what you're getting is 100% in growth. It's just the ASX 200. Whereas this one has 6 or 7 different funds inside it. So it's got a little bit of the US, it's got a little bit of Aussie, it's got some other global small caps, and so on and so forth, right? Whereas this one is just 100% Aussie shares. So in effect, this one is the up on the highest risk end, and this one is still very high risk, but it's not quite as high. So if I could maybe give them a risk rating out of 10, just like hypothetically, I would say that maybe this one's a 10 out of 10. Like, let's be honest, crypto and all that rubbish is way more risky than this, but I'm just giving you a sense of it. And this is probably like a 9 out of 10 because you can see it here, right? 9. And so you're getting a bit more risk, but that explains the slight extra return that someone might get. Now, there are alternatives to this STW. There's like, for example, VAS, which is the one that we own at Rask Invest. There is also A200 from BetaShares. There is IOZ from iShares. These are all kind of equivalent style ETFs. It doesn't really matter. They should all be about the same in long-term performance. VAS will just be slightly different. So basically it becomes like, how do you do this? So the reason that this one has 10% is because effectively they're saying, well, you could have a little bit of diversification so that if the 90% falls a little bit, you could tip some of the defensive stuff into the growth stuff at a weak point in the market. And over the long term, it will smooth the ride. And so for some people, this will be appropriate. Maybe for some people, this might be appropriate. But what anyone could do if they wanted to do this, and I was chatting to a financial advisor this morning, actually, over breakfast, another one again. I have all these financial advisors in my life. What they were saying this morning is in the United States, so if you go see a financial advisor in the United States, what's really common over there is basically you might have like, I don't know, let's say you've got $100,000. They would basically say, well, let's chuck 100% of it into, I don't know, say something like this. They have the S&P 500 or something like that. Let's chuck 100% of it in there, and then always just keep your separate emergency fund in cash. Because then if you took the whole thing, effectively what you're doing, if you took the whole of the person's wealth, effectively what you have is a 90-10 portfolio, like 90% growth, 10% defensive. You just do it with cash rather than in one ETF. Now, we get a question like this for our, I just caught up with the apple pie comment. I often get a question like this with our Rask Invest service because people compare us to both of those things. So for example, if we log into Navexa, this might just take a sec because my internet's a bit buggy this morning. But if we were to log into Navexa and we were to look at the Rask Invest portfolios, people will say, well, why don't I just invest with VDHG? Or why don't I just invest in that rather than just do it? You guys do it. And there are many reasons why. I would suggest it makes it easier for us to do it, even if we do take a small fee, but we won't get into that. But the key thing is this. If someone chooses one of these out-of-the-box solutions like VDHG or VDGR, which is the 70-30, or VDBA, which is the 50-50 one, or DHHF or DZZF, or one of those ones from BetaShares, the difference is when you choose one of these, you're basically stuck with it for life. And when I say life, I don't mean your entire life. I mean the life of your investment. There's no way you can change it. So you can't wake up tomorrow and go, oh, well, I'm no longer interested in being 90% here and 10% there and a little bit in the US and a little bit spread over global. You have no control. Whereas if you build a portfolio yourself, you don't have to sell the entire thing in order to then rebuild the portfolio or to move it, to wiggle it. So that's why, and this is not, anyone can just copy our portfolios. This is not me selling it, but if you looked at our three strategies here, you can see it in the menu, 90-10, 70-30, 50-50. The reason that I did that is because if someone came to us, not that this has happened yet, but if someone came to us in 10 or 20 years and they see that we've got three portfolios, right? And in those portfolios, so one was 90-10, one was 70-30, and one was 50-50, right? Make that just a tiny bit prettier. Basically, what we're saying is if you're in, these are just individual ETFs inside. So in terms of building blocks, the way I think about ETFs is like building blocks. And then inside those, there's a few different ETFs, right? And it looks something like this, let's say. Basically, when you invest in one of these off-the-shelf ones, they're putting all of the building blocks together in one go for you, and you have no control. You just need to pick up a whole new stack and then move it somewhere else, or sell it, or replace it, or whatever. But with our portfolios, because all of the building blocks are the same, they're just in different proportions. What we're saying is, if someone was to move from this one to this one to this one, or from this one to this one to this one, we wouldn't need to sell the whole stack. We would just sell this bit and then rebuild it without that bit. So from a tax perspective, it makes so much sense. And people don't think about this because they just think, oh, well, this one's performed better in recent years, I'll buy that one. Or this one seems easy now. I think this ETF, VDHG or DZZF, one of those type of ETFs, is probably the best ETF in Australia for someone that has under $20,000 or getting up to $20,000. Like, I just think these just make so much sense. They make so much sense. But as someone becomes more sophisticated with their investing or starting to plan for retirement, I personally think that these are very limiting. And while they might work for beginner investors or people that are hands-on, I don't actually think they're good for people. I don't think people have fully thought through for a long-term perspective, from tax perspective, from a transitioning perspective. But one thing that you can do, so even though I've said all this, is let's say you do have one of these and it's 10% defensive, is just build up the cash balance outside of the ETF. So just start building up the cash over here. So then if you took it all together, that whole portfolio might now not be 10 and 90, it might be 80 and 20. And so that's probably one way to kind of get around this idea. But I know this is just one little question, but I get it a lot. And I thought it's worth mentioning on probably one of the first live shows. So I think it was under VDHG in our community. If you're not already part of the community, it's so easy to join. It's free. And I try to jump on every day to answer people's questions. So here we go. This was done by SLT. This is a wonderful post. I'll pop this in the YouTube comments here. So this was a comparison of all the different common ones that people see, and SLT's kept following that. So you can see discussions, like that happening in the community. So Centimeter Perfect, you said, if an ETF holds 10% non-income producing assets like gold, is the interest for debt recycling purposes only 90% proportional? So that's where that you're right, Centimeter. So that's where people have to be careful, is how much of it, right? So in this instance, let's say, for example, if we go back to our example, and we had a pre-built ETF like a VDHG, which is a diversified one, or DZZF, or one of those, whatever, doesn't matter. How does the accountant know which one produced income and which one's foreign income and which one when they look inside the ETF? Or does the accountant just assume that all of it's income and some of it's capital and whatever? Like, they need to be sure that they're apportioning it correctly. Whereas when it's a simple ETF that produces income and they get the tax statement from the ETF provider at the end of the year, it's a much easier calculation. So what I would say to most people is just keep it simple. And what I mean by that is not necessarily go for an out-of-the-box thing, but make sure you speak to your accountant who will help you to keep it simple. Make their life easy by asking them, hey, I'm going to do this. How do I set it up so I don't make your job more difficult and it costs me more money, or I find out in 5 years that I shouldn't have been claiming interest and the ATO is going to do something about it. Get the right advice and set it up correctly to begin with. Because we had a similar conversation with a financial advisor who was actually creating some content using our example for debt recycling, like our strategies for debt recycling, and saying how that may actually work. But it actually gets quite complicated if you actually scratch below the surface. So I hope that makes sense. There was another question. Where is it? I think it was in here rather than show you everything that's in the spreadsheet. Oh, here we go. So this was the question here. Here we go. So the question, which was similar to this one, was, would you rather have $500,000 in shares and no mortgage, or $1.5 million and a $1 million mortgage? So, okay. assume the property is the same in both scenarios. Okay, so in this instance, they're asking a question of, so 500K shares or 1.5 mil shares with 1 mil mortgage. So let's talk about this. Let's get all this stuff out of the way for a second. So the question is basically this. Which one would you prefer? If you have an opinion on this, I would love to know what you think. Which one would you suggest? What would you prefer? Let me know in the comments. Let me know what you would prefer. I think the answer to this question for most people, obviously I can only be general, I think the answer to this question actually comes down to basically what are their long-term goals. So in this instance, this side of the equation is probably more suitable to someone with a long-term goal of growing their wealth. Whereas this one would probably be much more suitable to a retiree because there's no debt. A retiree doesn't want the stress of debt. So they probably just want $500,000 in shares. And if they invested this correctly, they could probably get 4 to 5% in income. So income, we'll go income, 4 to 5% of income, like that. And then they could probably get an extra 3 to 5% in growth. So in that way, they're going to walk away from the table every year with, say, $20,000 of income, right? $20,000 per year of income. And they're probably going to get enough growth so that the portfolio stays largely the same. So it stays largely at $500,000. Maybe it grows to $510,000. So they've got their purchasing power. And this is what we think about when we do retirement planning is the 3 to 5% of growth actually protects people against inflation, and the 4 to 5% allows them to withdraw an income. Now, obviously, you can start eating into the income and you could say, I'm going to take 7% this year or 6%, or maybe I don't get as many dividends. And so that would fall below $500,000. Or maybe the portfolio does better than 5 plus 5 equals 10%. Maybe it does 12%, in which case it would go up, even though they're drawing an income. So, whereas on this side, you're going to get basically everything magnified. So you probably still get the 4 or 5% return. You probably still get the 3 to 5% growth. But what you'll have is a big subtraction, a big negative from the 5% or 6% that you pay on the mortgage. And then you'll have a tax deduction element. So in this case, if they used 100% of their loan, if they used all $1 million of that to produce income, it may be tax deductible. So in that instance, they may be able to claim the full thing as a tax deduction, in which case it's not actually a 5% cost. Like they have to pay 5% interest every year, but then they can claim some benefit back from the ATO. So it might only be 3.5% after tax deductions are factored in. So then in that case, this would work well over the long term because their returns would be better than their cost. However, in this instance, they're obviously going to have to keep servicing the loan. It's a higher risk strategy. They need to still speak to specialists and experts before setting it up, or just at least get a second opinion. Now, for me personally, as who I am today, it makes so much more sense for me to do the second option because I'm younger, I've got a high risk tolerance, I've got a long-term investment approach. I think I'm a half decent investor, even if I use a core portfolio of ETFs. I think I can still beat whatever it is in my interest that I'm paying. And I've got a salary that can cover the cost of the mortgage, even if I don't receive any income, or even if I just reinvest the dividends back for more growth. So that's no problem for me. It's for other people, it might be. So that's how this becomes a very kind of like situational style question. Another good question. So Centimeter Perfect said, how about VAS? I'm assuming that not all 300 companies pay dividends. Yeah, but the investment itself, Centimeter, so the investment in VAS itself kind of collects all the dividends. So this is a good question. It's like, how far down do you go? The investment that people are making is in the trust, which is VAS. It's a legal trust. So that's where the investment itself is doing that. But one of those ready-made portfolios, you can easily identify which ones, or you should be able to identify. So you just got to be careful with that. You just got to be mindful of it. I guess it's not a big issue, but just knowing how much of it is actual income. So Dino, you've said, what are your thoughts regarding the 2 share portfolios like VAS, VGS, simple and easy? Yeah, I think a lot of people do them. And I think Perla, who is one of our partners here on the Rask Invest live show, I think they offer those 2 ETF portfolios for newer investors. So for a lot of new investors, I'm sure they opt for it. For us and for the types of people that invest with us, it's not enough. We need more diversification because we're trying to build more like professional style portfolios. So for me, that basically means, it sounds a bit mumbo jumbo, but basically what it means is when we build a portfolio for people or for our community, we're not just aiming for the biggest returning thing all the time. And that's a really valid point. It's like, why not just aim for the biggest returning thing? It's because most people don't stick around. Like most people, vast majority of people don't stick around for that ride. They often get thrown off the horse when it gets too uncertain. And then there's no point them actually doing it. Like there's a famous, not famous, it's a quote from Morgan Housel, and who's the author of Psychology of Money. They said, everyone's a high growth investor until the next market crash. And I kind of agree with that. Like if we know from history that the stock market falls 1 in every 5 years. On average, it could be 3 years in a row it falls, but on average, it's 1 in every 5. And a lot of people get the most enthusiasm right before it falls. So a lot of people then sell out at a loss, and then they wonder, well, maybe I should have just been defensive the whole time. And I think for the first time in history, with ETFs being so low cost and so accessible, but also the ability to build a truly diversified portfolio with ETFs from all different types of sectors and markets. You got Aussie small cap or mid cap shares. You've got Aussie large cap shares, so blue chips, ABC. You've got global shares like US. You've got maybe you could chuck in some emerging markets in there. And then you got some cash or some bonds, The good thing is right now, people can get good returns from a cash ETF, great returns from a bond ETF, pretty good returns from an Aussie shares ETF, including blue chips that are paying good dividends. US shares are obviously doing really well, and emerging markets seem to be coming back a bit. So basically every part of a good portfolio that's truly diversified, not just a 2 ETF portfolio, is really, really great. Now, some people might say again, well, I'll just get a 2 ETF portfolio, cut it down the middle, and then I'll add to that a bunch of cash and term deposits and my property, so plus house, and that's me sorted. In which case, some people would probably go for that and be like, that's a good way to do it. And they probably got super over on this side. I don't know what I'd draw super as. I say this is the Aussie super building, Australian super. Maybe it looks something like that. Then people might have that financial situation. Simple ETFs, lots of cash in the bank that is not just for investment purposes. It's for emergency. It's for all those things. They've got this industry super fund and they've got their property, which they're ahead on the mortgage. Happy days. And that's totally great. I hope that makes sense. So we've got a lot of questions around this debt recycling, using debt to invest. We're going to have to do another podcast on this. So W said, I think it boils down to the risk also. $1 million loan sounds a bit too risky for older folks. At 9% growth in 8 years, Case 1's portfolio would grow to $1 million, while Case 2's would grow 3 times to $3 million. Yeah, so that's the arithmetic, right? Is this one here wouldn't grow as fast and wouldn't be as meaningful as this one, but this one here, you're going to take a lot more risk than this one. So a lot of people wouldn't go for that. And that's where, seeing a good financial planner, to sit down with them and say, hey, this is my situation. These are my goals. What can happen? What's the best one? And oftentimes you'll find that someone in the relationship, like I'm probably more suited to this one, which is the second one, but my wife is probably more suited to the first one. Doesn't really like a mortgage, right? More traditional in the way she thinks about money and lower risk. And that's where the financial planner will be able to take both of those people's situations into account and combine them to say, well, let's go somewhere in the middle, or hey, you can have this and you can have this. And how does that sound to you guys? And that's kind of the essential element there. Now, I realize it's just struck 1 p.m., but one of the things that we've talked about today is obviously using debt for investing. This can be very risky. I want to make it very clear. So go and speak to the experts that you need. As Jordan said, a good mortgage broker can help when it comes to refinancing. I use Flint. I have for years. Most of our community is now slowly when they think of refinancing, they go to Flint, which is great. Tax agent, get a good tax agent. Like some people call their account. If you're one of these people that call your accountant and your accountant's gets back to you in like a week or doesn't answer your phone call or is not really helpful. Like I spoke to a guy the other day, a wonderful person, and he'd been with this accountant for so many years. The accountant helped him with his business and all this other stuff. And not once did that accountant ever think about helping this guy out and being like, hey, maybe given where you're going, you should probably think about this. It would have saved him tens of thousands of dollars in tax within a matter of months. And never once did the accountant think to do that. Like if you find yourself in that situation, get a new accountant, shop around. The beautiful thing about an accountant is they don't charge that much per hour. Even if they're quite good, they're still pretty reasonable compared to some of the other professionals like lawyers or financial planners that you might see. If you need a financial planner, I think financial planning is a wonderful profession now. I think 5 or 10 years ago, it was pretty horrible. There were some really dodgy, particularly older type of financial planners, like really stuck in their ways. But now we're seeing this new crop of financial planners come through. They're ethical, they're really tech focused, they're long-term focused, they don't get weird commissions. Like it's a really good industry. And that's why I've gone back and started studying more financial planning, to be honest. Hopefully next week we can talk about more than just ETFs, diversified funds, and debt recycling. That's not how I thought the first Rask Invest live show would go, but I'm glad we came here anyway. So don't forget, you can access financial planning, free courses, investing. We're actually revamping our Rask course service. The life insurance you can get, we did a recent segment of that, financial planning, and the accounting is just /accounting. So if you want to book in a call with Jordan or any of the accountants, you can go through the process and you can do that here. So that's all available to you on the Rask Media website. Just head there /accounting. One of the things that I should flag is that next week we are doing, where is it here? Bring up the live show. Next week, we are doing the section how we add to the fake news portfolio. So if you do have any suggestions for adding to the fake news portfolio, can you please do me a favor and head over, I'll bring this up here. Can you please do me a favor and head over to the Rask community? I hope that makes sense. Percy, you said, let's get Owen to answer other questions and not go down a rabbit hole of one topic. Yeah, so I'm happy to answer questions, and you can just chuck them in the Rask community. Like, it's not just me in there that's answering questions, so you can jump in there. But next week, don't forget, we've got the same place, same time. So next Thursday, we're going to be adding ideas to the Rask Invest live fake news portfolio. I don't know if you all saw this, but have a look at this bad boy right here. Our investment in Home Depot from last month, our investment is already up 7%. And the one for WiseTech, already up 8.7%. So in effect, this portfolio is already looking green, which I like. So you can track this portfolio by heading to live. You can also use any of our partners. Remember, Navexa, if you click this link on this page, it takes you to the landing page. You get 20% off. Pocketsmith, I think you get the first 2 months 50% off. So it's like $7 to try Pocketsmith, which is by far the most advanced budgeting tool in Australia and New Zealand. Like, it is amazing. Super Guide has fact-checked superannuation guides for people with SMSFs or in retirement. Wonderful resource for retirement. You can invest with us in Rask Invest. And if you like investing in your own ETFs and shares, like I use Perla for shares and that type of thing, you're going to see more of us using Perla in the future when it comes to us putting things into the portfolio and reviewing companies and that type of thing. So go and check that out. So there's a lot. So DHHF is VAS and VGS all in one. Yeah, so DHHF is pretty much similar to that. It's not exactly that, but that's the idea. Percy, you've said, this is a great idea, coach. Is this going to be once every month like the fake news portfolio? Yes. So once a month, we will do the mailbag. So the last Thursday of every month is the mailbag. Next month will be more structured. I won't have lights and cameras and all this stuff around me. We'll be more structured. And the first week of the month is the fake news portfolio. And remember last week we had Effie Zahos on. We're getting more experts in the mix, and they're all getting lined up for the future. So every Thursday, 12 at midday, and then we're going to have these recurring themes. We've got Pete. We're going to have Pete Wargent coming up soon, and he's going to take us through a show that's really, really popular on Rask podcast called State of the Markets. This is where we review all of the economic data, so like inflation, US interest rates being cut, where the stock market is, how's gold going, what's happening in cryptocurrency. We're going to look at all the big picture stuff, and we jam it all into about half an hour, 40 minutes, so that we can make sense of it. And we just have to do that once every 3 months. This is how much I need. Every 3 months is enough for me. Put it all in there, all the things that matter, and then we serve it to you and we go. If you only listen to one thing about the economy every 3 months, make it this 40 minutes. Bang, done. I like that type of efficiency. So bring on Costco. So, well, that's one of the things, Percy. We didn't add it, as you mentioned earlier on. We didn't add Costco to the list. It seemed like the community was kind of divided on that. But we can talk about Costco again next Thursday. So if you haven't already seen the last fake news portfolio, that was in there. That was in the mix. Okay, don't forget, if you're new here, you can join us online. You can invest with us. You can take free courses on Rask Education. We just made our first value investor program is now free. Our second value investor program with Equity Mates, is currently on special. If you use the coupon code MATES, MATES, you get it $100 off. So it's normally $499. You get it for $399 if my maths is correct. So that's on sale until Saturday. I think it's Saturday morning or Saturday night. So if you do like to learn about investing, get all my valuation spreadsheets, all that sort of stuff, as well as have actual companies in there, that's the program for you. Okay, thank you so much. ZX, this is a good question. It's actually related to Rask Invest, which is why you probably come here. Is the Rask Jupiter target return 7.5% after inflation, after fees? So the targeted return is 7.5% ZX. That's what I wanted to put in there, and I'll tell you how I got to that. So that's here. The reason I did that is because I truly believe that we can achieve that goal. I could have, do you know what, ZX, legally, I probably could have put in 12% in there or whatever, really, that, and I could just justify it. But I wanted to set expectations low and then over deliver. So I hope that makes sense. So the 7.5% is just an absolute number. I want to achieve beyond that. Do I think we can do that? I can't say for sure. The past performance is not indicative of future performance. The future is unknown, all of those things. But I'm going to try and target, obviously I want more than that, but that's a really good question. And if you want to book a call, ZX, you can speak to myself or the team by clicking book a call at the top of the website there. So anyway, back to this. It is $100 off if you use the coupon code. I'm just going to make sure it is before I say good day to you. But if you use the coupon code MATE, so I'm just going to make sure of this. Yes. Okay, cool. It is $100 off. Yeah, cool. That's until Monday. So if you're interested in that sort of stuff. All right, Sona, Percy, so Dino, ZX, everyone, thank you for joining me today. I know today was a bit deep in the weeds of just investing in general, like in debt cycling and all that. We probably don't normally go this deep into one topic, but I'm glad we did because it's clearly that it's really important to you. So yeah. Anyway. Have a wonderful weekend. Have a wonderful week. And I will see you next Thursday. If you go for the Brisbane Lions, I'm cheering for you. If you go for Sydney, I'm also cheering for you. The two most followed clubs in all of Australia, all of Australian sports, Brisbane Lions and Sydney, and they both happen to be in the grand final. And there are thousands and thousands and thousands and thousands of fans outside of this office, out on the streets of Melbourne right now, because there's a huge weekend happening here in Melbourne. And thankfully they don't drive or take the train too much, so I can kind of get to and from the office, which is great. So thank you to everyone that does come down to Melbourne and supports the team. It does wonders for our economy. And I will see you next week. Go the Lions, go Swans. I'll see you next week. Bye for now, everyone. Thanks for joining me.